Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, September 8th, 2023. The stock market's recent weakness is being blamed in part on Apple, which closed yesterday 6% below where it finished last week after China forbade its government officials from using iPhones and may extend that ban to all state-owned businesses. Since Apple is the most valuable publicly traded company in the world, it has an outsized influence on all the major stock market indexes. And here's a chart of Apple year to date, and you can see, like the rest of the stock market, it peaked at the end of July, had a nice rally going through the end of August, but then just within the last week, you can see this drop here. And from a short-term perspective, that's clearly true. Since the end of last week, the Spider S&P 500 ETF Trust is down less than 2% and has lost less than 3% since the end of July, while the Apple is down more than 9% since then. So you can see here the chart for the SPY is a little less severe than it is for Apple over here on the right side. Presumably, had Apple merely held its own over the past 5 weeks, the SPY would be showing a gain instead of a loss. But from a longer-term perspective, Apple is not the problem. Despite its underperformance since the beginning of August, Apple is up nearly 16% over the past 2 years. Now I'm going to show you the 2-year chart of Apple. Way over here on the right, you can see the big drop in August, and then it's rallied during the last week, and then it's dropped over the past few days. But even still, if we go all the way out here to the left, Apple is up nearly 16% over the past 2 years, while the SPY has gained less than 2%. So here's now the SPY over the past 2 years. Here's where it is today. You follow this dotted line all the way over, and it's just barely higher. Had Apple only broken even over the past 2 years, the SPY decline would be even bigger than it is. Rather than blame convenient scapegoats to explore the stock market's languid performance over the past 6 weeks, Wall Street need look no further than the two macroeconomic factors suppressing economic growth. Oil prices, which are at their highest levels this year. And here's a chart of crude oil this year. And you can see over here on the right, they're showing a price of almost $88 a barrel. And if we take this out a year, you can see that late last fall, November, they were a little higher. But so far this year, it's the highest they've been. Also interest rates, which are also higher now than they've been in a long time. Here's the yield on the 10-year Treasury note. And it actually peaked a couple weeks ago, but even still, it's considerably higher than the start of this year. Now, in the case of the 10-year Treasury note, you can see last fall it came pretty close. But if we go out, say, 5 years, you can see it's clearly higher even since before the pandemic. The simple fact of the matter is that higher energy and borrowing costs are a drag on the economy. That explains why energy was the only sector of the S&P 500 index that gained ground in August, while all of the other 12 sectors were negative. And here's a chart from Yardeni Research, and you see kind of this bluish green teal line up here in positive territory. That's energy up 1.3%. In August, everything else is negative. The worst performing sector was utilities, and that's this green guy down here at the bottom, down 6.7% in August. And utilities, first of all, consume a lot of energy, and they rely a lot on borrowed money to finance growth. Consumers also rely heavily on credit to finance purchases. Since cresting to 4.7% in May, the U.S. personal savings rate fell to 4.3% in June and dropped again to 3.5% in July. We'll find out what that number was for August at the end of this month, but I wouldn't be surprised if it fell again. Now, that's concerning because less savings means consumers must borrow more money to keep spending at the same level. After 18 months of rising interest rates, we have reached the proverbial place between a rock and a hard place. If the Fed keeps raising rates, businesses and consumers will have to spend less. That might drive down the growth rate of inflation to the Fed's target of 2%, but at the likely cost of rising unemployment and a contracting economy. That's why some Fed officials have been hinting at a continuation of the current pause in rate hikes when it convenes the week after next. When you're between a rock and a hard place, the last thing you want to do is start an avalanche. That's this week's PF video update, and I look forward to talking to you again in a week. Thank you.